Welcome to M&A Unpacked, the weekly show where we bring on experts in MSP M&A case studies from those who have gone through or are going through the process and top M&A and business minds to help you maximize the value of your MSP, whether you're buying, selling, or just trying to improve your business. Make sure to subscribe to the Kaseya YouTube channel to see, so you know when the full episodes drop, and you can even save the M&A Unpacked playlist for easy access. And today I'm joined by Chris Bologna, COO and CFO of Xperteks. Chris has been in the business and finance spanning something like 25 years. And we had a conversation the other day, Chris, you used to work at Blue Note. I thought that was pretty cool, which for people who don't like jazz, which is probably one out of every 100 people, or don't know jazz, it is a jazz club in New York City, and I frequent a lot of jazz clubs in New York City, so I thought that was pretty cool.
You know, Mike, I want to be very honest with you. I love live jazz. I don't listen to a lot of recorded jazz because I don't feel like it comes off the same way.
That's
I'm
okay.
all about the loud and abusive tunes. I love rock and roll. I love heavy metal. I do appreciate jazz, and I have to tell you that my time at the Blue Note was an incredible time. I got to meet and talk about music with Grammy Award-winning musicians, somebody like Chick Corea, who's got like 15 or 20 of them, got a lot of tips, never made it in the industry, but man, did they really help me to become a pretty good player.
Awesome. And you also worked on Wall Street before the MSP industry.
I did. I was a financial planner with A.G. Edwards and Sons. The firm is no longer in, I don't want to say in business. They were acquired by Wachovia. Then Wachovia in 2009 was taken over by Wells Fargo. So in essence, I worked for Wells Fargo, but at the time, the name of the firm was A.G. Edwards. And I had a good time working there, got a lot of licenses, got a CFP, learned so much about finance and trading and M&A and stocks and things of that nature.
Yeah, and I remember A.G. Edwards, so I'll age myself a little bit. Wall Street to the MSP industry, how did that transition happen?
You know, it's funny. I have always loved money and finance. If you've ever watched Family Ties, I am Alex P. Keaton. Not a big Richard Nixon fan. The only reason I say so is because before my time. But when I worked on Wall Street, I knew absolutely positively nothing about technology. I could hook up a 48 channel mixing board and, things like that. But when it came to networking and telephony, I was an idiot. I knew absolutely nothing. As I left Wall Street, I began to work for various companies in an accounting role. The controller at the Blue Note was obviously the first one that we, had discussed. I had moved on to a couple of other different industries. One was experiential marketing, believe it or not. And by chance, I wound up at a interconnected VoIP company. And I started learning about networking, and I started learning about telephony, and I started learning about techie stuff. And it was amazing. And I loved it so much that I learned how to administrate a BroadSoft switch. And I learned how to configure, companies, handset telephones. They didn't have soft phones at the time. And I learned about config files, and I learned about XML and all of these cool things. And I was hooked. And we had acquired an MSP during my time there. And then I really started to learn about the MSP business because I had to dig into that acquisition company and really dig into their financials and really dig into their business model and how it all works. Taxation, the revenue recognition, how to service the client. I found out what a PSA was. I didn't know what a PSA was at the time. Now, I'm going to say a dirty word here for you, Mike, okay? That this was a ConnectWise shop. But I learned how to use ConnectWise, and I learned how to administrate it. And I learned how to get good data inside of there and pull it out and turn it into money. I love Autotask. I am an expert in Autotask. I think that it's a little bit more functional than ConnectWise. I think that Kaseya/Datto/Autotask are much better run companies. And I couldn't stop. I learned how to write code. I learned how to fix people's IT incidents. I never say issues or problems. They're always incidents to us. We don't want to use negative connotations. And I have been doing it since 2008 in that particular industry, whether it be VoIP or MSP. To this day, I still administrate customer telephone systems here at Xperteks. Why? I like it. It's fun. I use one provider and one provider only. I'm not going to do it on anybody else's provider, but it's so much fun to make the system do whatever it is I feel like doing, whether I have to do it on the front end or through the API.
Love it. That's pretty cool. They keep me away from any technology here at so.
They try to do that here. They tell me I know enough to be dangerous, but I don't care. I do it anyway.
Well, we're going to talk a lot about accounting and finance here, but before we do that, I kind of wanted you to just give us the basic background of what Xperteks has done in M&A since you've been there.
Sure. Look, we're always looking to grow the company. We're always looking to accrete value to the company, right? Organic is always a great way to go. At times it's slow unless you've got the world's greatest sales force, or you open a couple of whale accounts, which is not the typical way that things happen in this industry. You're hitting singles all day long. Every once in a while, you're going to hit that home run, but it's not every day. Okay. The acquisition model, in conjunction with an organic growth model, is going to accelerate the velocity of your CAGR and your growth and your top line revenue and everything that you're looking to accomplish in this business from a financial aspect. I've looked at a number of deals here. Okay. I would say at least 50 to 75 deals. We've pulled the trigger on a couple. And what I really want to talk most with you about today is not the deals that we actually wound up doing, but the deals that we didn't wind up pursuing and why we didn't wind up pursuing. Because this is what the MSP owner needs to know if they're looking to acquire, be acquired, or even sell equity.
Yeah, and that's really interesting to me, and I think it's going to be hugely interesting to the folks watching this because we haven't dove into that in as much. We talk about that, but you're now the first financial person to come on the show, so this is going to be really cool. Let's first of all tell me what GAAP accounting is. And you talked about it on the M&A Minute, the short podcast where we just give a quick tip, and you gave that as a tip, and I thought that was great. So now, for the folks who've watched that and are coming here going scratching their head, going, what is GAAP accounting, and why do you emphasize its importance in M&A transactions?
Sure. GAAP accounting stands for Generally Accepted Accounting Principles. What does that mean? It means it's the universal language that accountants speak in when we're analyzing financial statements, right? What's a financial statement? Your income statement, also known as a P&L or a profit and loss. Your balance sheet, your statement of cash flows. The way that it works is that your income statement flows to your balance sheet, which holds your assets and your liabilities and determines your equity. The cash flow statement takes the balance sheet and converts it into cash. How much cash did we put in the bank this month or this year or this quarter? Now, the main thing about GAAP accounting that everyone needs to know, if you don't already know this, is that GAAP accounting is the accrual accounting method, not the cash accounting method. What's the difference? In the accrual method, when I create an invoice and I send it to Kaseya for $1 million, I recognize that income right then and there on my income statement. Whereas cash accounting, that same $1 million invoice that I'm going to send to Kaseya, hope that they pay, it is not income on my income statement until that invoice is paid. The cash is received. It is not income until the cash is received. Accrual, it's income on my income statement once the invoice is created or once the vendor invoice is entered onto the books. Same thing with the cash accounting and the expenses. It's not an actual expense until I pay the invoice. The best differentiation that I can make between accrual and cash accounting is that most people keep their books in accrual. Okay. They recognize the income when the invoice is created. They recognize the expense when the income is created. But when you do your tax returns, that's not advantageous to you. You typically want to account in cash. Why? That same $1 million of invoice that I sent to Kaseya, maybe I sent it on 12/31, right? And I'm not reporting my taxes until April 15th or 18th, depending upon whether or not there's a weekend. But Kaseya didn't pay that invoice until January. If I include that in my tax return, then I'm paying taxes on money that I have not received. And this is why you account in accrual or GAAP and why you report your taxes in cash. In a nutshell, that is GAAP accounting. Mike, I can talk to you about this for a week straight, but those are the major differences between the two accounting methods. And these are the results that they produce. You're more than likely going to get a better EBITDA number in GAAP than you are in pro forma or cash. That's going to up your sale value, okay? Or that's going to help you get funding if you're funding an acquisition through debt. Or if you're selling equity, that's going to make your equity more valuable. Why take $500,000 when you can take $1 million with proper accounting? These are larger numbers we're talking about in M&A. And if your numbers aren't right, you may really be shortchanging yourself and doing so in a very big way. That's GAAP accounting.
Very interesting. And can you put that into kind of paint a picture for me here? Like, how have you, because you've now looked at, you said 50 plus deals that you've had the opportunity to look at. You're looking at their books from that perspective. What have you been seeing, and how has that hurt or helped people?
Well,
Like from not you, but how does that help the MSP if they are in GAAP, and then how does it hurt them when they're not?
so there's a number of different ramifications, we'll call them, that can happen if you're not accounting in GAAP. Okay. We talked about the EBITDA number, which ironically enough is not a GAAP term. It's gross income. Okay. That's EBITDA. But it can hurt you from the analysis level in so much that it's going to take me a lot longer to analyze your deal. Okay. It's not in the universal language of GAAP. That means I'm going to have to spend more time auditing. I'm going to have to ask a heck of a lot more questions. If a letter of intent is signed, before I even send an auditor in there, I want to go in there myself and look through the entire general ledger. And I want to see how far outside of GAAP compliance your company is. If you're very far outside of GAAP compliance, it's too cumbersome for me to try and figure out how to get you into GAAP compliance, if I can even accomplish that goal. Because remember, I don't know your business like you do. That's your baby, not mine, right? Mm-hmm. And there's a lot of things that go into the accounting. Let me give you a great example. I'll give you two great examples, actually. When I first came to Xperteks, we were in accounting in a method that was accrual, but it wasn't GAAP. Okay, it was more of a pro forma accounting. And the first thing that I did when I came here was I converted us into GAAP accounting. It took me about a month. Okay, once I did, our EBITDA number practically doubled. So hypothetically, if the owners here were trying to sell the company based on the pro forma EBITDA number, they would have gotten half as much as they could have for the company. Whereas if they were in GAAP, guess what? They get double. I always like a two-bagger. I'm pretty sure you do. I'm pretty sure everybody else out there listening wants, at least a two-bagger on that number. And all it takes is converting it into GAAP accounting. It's the universal language. It helps me perform my analysis quickly, unless you want to slow your deal down, which most people don't want to slow their deal down, right? They want to get it done. They want to get it to close. They want the flow of funds flowing. They want to see the cash hit their account. They want to sign those documents, and they want to take their money. Okay, that's number one. Number two, the auditing fees. If you're not in GAAP, you're going to spend a lot more money on auditing fees, okay? Because especially if there's a lender involved, they're going to want an audit. They're going to want a quality of earnings examination. These guys are going to come, they're going to sit in your conference room, they're going to take it over. It's going to look like a war room, like an NFL team drafting their team, okay? And they're going to pour through everything. And they're going to pick the biggest transactions that they see. And they're going to call up the client and they're going to say, hey, did you receive invoice number 12345 on July 25th in the amount of $10,000? Okay. They're going to nitpick at all of that. They're going to say to you, this is not in the right accounting period. Let me give you a great example of accounting periods because that's a big part of GAAP. Okay. Revenue recognition, how you book your revenue, when and how it hits the income statement or the P&L is probably one of the most important and scrutinized pieces in the accounting world. Here's an example. We just signed a client. Not a huge client, it was more like a double, wasn't a single, but it wasn't a home run, but they seemed like they're going to be a good client. And we charged an onboarding fee. An onboarding fee was approximately $7,500. We invoiced and they paid the fee in April. Okay. We just finished onboarding the client. Lo and behold, I'm sure a lot of MSPs out there have run into this. They were still under term with their old MSP. That turned into a lot of wrangling, a lot of negotiation, a few emails, a couple of phone calls, et cetera, et cetera. We just onboarded them 2 days ago. So I invoiced them in April. And they paid me in April. So for cash purposes, that income is in April because I was paid in April. But for accrual accounting and GAAP purposes, where does that income belong? It belongs in July because we cannot recognize the income in accordance with GAAP standards until we complete the work. Why is that? Well, maybe they back out. Maybe they couldn't get out of the contract with the old MSP. Maybe something went wrong. Maybe they went bankrupt and we have to return the money because we can't provide the services. Once the services are provided, that's when you can recognize the revenue. And that's what I'm talking about, revenue recognition. Now, where does that $7,500 go? It goes onto my balance sheet. It's a liability until I finish the work. Why? Because I may have to pay it back. But once I've completed the work, I've done the job, I've earned the income, and then I can journal that out of my deferred revenue account on my balance sheet and over to my income statement in my, my setup fees line. Okay. And that's the way that all of this works. That's why GAAP is so important. This is what they're going to scrutinize. And I want people to know about this because I'm not sure that the VCs or the PEs or the investment banks, unless they're your investment banker on the sell side shopping your deal, are going to tell you about this. Why are they going to tell you, hey, Mike, you want $500,000 for your company? That's not good. I'm not giving that to you. I'm going to give you $1 million. Said absolutely nobody ever, right? It's up to you. There's a legal term called caveat emptor, and it means let the buyer beware. And the buyer, considering the fact that they're likely spending hundreds of thousands of dollars, potentially maybe even millions of dollars to acquire your company, they're going to do their due diligence. If they have any level of sophistication, they're going to put you through a due diligence process like you would not believe. And we're talking about those auditors sitting in your conference room. We're talking about lawyers. You better have a good one on your side because you need to negotiate either a stock purchase or an asset purchase deal, right? And you want to make sure that the language in there is buttoned up. All of these things play into the M&A process. And it's of the utmost importance that owners looking to shop a deal or buy a company understand this process and understand that the underlying numbers inside of this process have to be spot on. There's money involved, okay? I don't joke around when it comes to money, okay? And I want to make sure that if I'm selling the company, I'm getting as much as I'm entitled to fairly. And if I'm buying a company, I want to make sure that I'm paying a fair price. I'm not looking to shortchange the little guy. I don't think that's right. Okay. I want to get to a true EBITDA number. I want to decide on a multiple. We'll say 5. That's a very typical number. And I want to pay you a multiple of 5 on that EBITDA number. Not everybody's going to tell you this. Nobody talks about it. I understand that accounting is boring. Nobody loves talking to accountants. Okay. When I talk about debits and credits, my CEO, his head spins. He's like, what is going on? I don't even know what you're talking about. You're speaking like some alien language to me. Do we have enough money to pay for this or that or the other or not? Okay. These are the things that I look at. The number one reason deals don't close with me or they don't get to the letter of intent stage is because the accounting is very hard to decipher. I'm speaking English, but I'm analyzing Chinese, right? But when you're in GAAP and I'm in GAAP, it's apples to apples. I'm speaking English, you're speaking English. We can analyze the deal. We can come up with the appropriate multiple. We can have a conversation. We can bang out the stock or asset purchase agreements. We can sign them. We can get to close. You get paid. I get my customers and the IP or anything else that comes along with the acquisition, and everybody's happy.
I'll tell you what, you did a pretty good job. As somebody who obviously must have loved accounting so much that he took accounting 100 twice. Once the second time was to get the shock and awe of the first time I had to wear them. So that is to say I'm very sophisticated when it comes to accounting, but you did a pretty darn good job of explaining it in a way that I actually understand. I mean, the takeaway here is that, listen, if you're selling your MSP, you better be in GAAP accounting because the buyer is going to be in GAAP accounting. And
well, the lender is going to expect that the buyer may or may not be, to be honest with you. But if they're going to a lender, they're going to make them do it. Now, if you've got enough cash in the coffers to just buy the company at a treasury, then so be it. Who cares? You buy the company and hopefully it works out.
And that's interesting. You said you came into Xperteks and switched them over to GAAP accounting, and you double that. You found the EBITDA number was double. I mean, how is that even possible? Like, that's crazy.
Well, I had a lot of expense that was in the wrong year. Now we work on a fiscal year, and our fiscal year ends on Halloween of all days. But something that was applicable to the prior year was in this fiscal year. Capital expenditures. When you buy a $2,000 laptop, it doesn't belong on your income statement or your P&L. It belongs on your balance sheet. It's a capital asset. You depreciate it. That's not an expense. Okay. So I had revenue that was billed out in the next month in November. That belonged in October, but it was in November of next year. So it was in the wrong fiscal year. I had to pull that back. I had a lot of expense in the beginning of the year that applied to the October of the prior year. I had to identify that and pull all of that out and do it really fast too, because our tax returns were done. You can't change these financial statements once your taxes are filed, right? Or else your tax returns are wrong. Okay. Then I had a lot of capital expenditures. Okay. They belong on the balance sheet and they were on the income statement. So maybe I had, we'll just take some round BS number. Maybe I had $25,000 worth of capital expenditures sitting on my income statement when they belonged on my balance sheet. They weren't expenses. They were capitalized assets that had to be depreciated over time. They were on the income statement. So moving that over right there, I don't recall the exact number. We're talking 7.5 years ago, getting up there in age, some of my memory isn't what it used to be. But that would have been $25,000, hypothetically, right to EBITDA. It goes right to EBITDA. It flows all the way down. There's no expense associated with it. You outlay the cash in the capital expenditure. It was a number of different things. One thing that I do see with a lot of smaller MSPs and businesses in general, it's not necessarily MSPs. I'm going to be very clear about this. What I'm saying today applies to any industry. It's not just MSP, okay? But a lot of smaller companies, the owners, they put personal expenses onto the company. Luckily, I wasn't, we weren't doing that here, okay? But I've seen it a million times. So now you're putting your personal expenses onto the company, right? What are you doing? You're doing two things that hurt yourself that way. Number one, you're lowering your EBITDA number. And now the person analyzing the deal has to go in and strip all of that out. If I bother to ask. Now I'll ask, okay? But I'm telling you, the $1 billion private equity firm, they're not going to ask, oh, look at these guys. He had $100,000 worth of personal expenses on there, lowered his EBITDA number. That's $500,000 less we have to pay. Here's the thing. If you put personal expenses under your company and you're taking a W-2 and you're not running it through the payroll as, a non-cash payroll item, you're committing tax evasion.
Interesting.
Okay, you're committing a crime. And that's not good. They don't want to see that. And hypothetically, if somebody messed up on a tax return, your CPA got in there and fudged a number, and they come in and they audit and they start seeing your mortgage payments and your card payments and bar bills and things like that, they're going to start asking. They're going to catch that. It's really going to stand out. And then you might have a big problem because if you don't pay the taxes, they can go back the whole way. There's no voluntary disclosure program for that where they can only look back 3 years because you messed up and you made a mistake. You didn't pay the taxes. They go back the whole way. If you've owned an MSP for 10, 20 years, you're looking at 10, 20 years worth of payroll taxes that you did not pay and income taxes that you did not pay. So the company now has a problem, and so does the owner. I do not recommend it under any circumstances. Pay yourself a little more, run it through the payroll. But the point that I want everybody to know about, especially with your accounting, now everybody here, Xperteks that watches this, they've heard me say this a million times, and they're probably going to roll their eyes when this comes out of my mouth. But whether it's your PSA or your underlying systems or your accounting, garbage in, garbage out. And you may be hurting yourself. That's why GAAP accounting is so important. All of your revenue is in the right month, the right quarter, the right year. When I test your revenue, I know that I'm looking at numbers that are in the right place. I know that your EBITDA number is pretty close to where it should be. I know that I'm looking at a company that's taking good care of their house, right? You want to invite company over to a dirty house? I don't. It's a little embarrassing, right? They may never come back. That's the other part of it.
All right. So we know we need to get on GAAP accounting. How do we do that? How does a MSP that's transition into this?
Well, there's a number of different ways, that you could do this. I mean, the most simplistic way, now it's going to cost you a little bit more than, a typical bookkeeper, is to hire yourself a proper accounting person into your company. And that's what Marcial did at the advice of, a very successful business owner. You need a proper CFO. He needs to get these numbers straight. He needs to be able to apply all of these metrics. I can tell you the profit on a customer by customer basis. That's how detailed I keep the accounting here. Okay. Hire somebody good. Doesn't have to be a CPA. Okay. They're going to demand more money because they're a CPA. But the honest truth of the matter is that a CPA, the only reason you really need that license is to sign off on audited public financial statements. We're talking about private companies here. Okay. Unless you're going public, you don't need a CPA. You don't need the premium. You need a solid private accountant with a good understanding of GAAP compliance, GAAP principles. Okay. That's number one. Number two, if you're bootstrapping a little bit, right? What does that term mean? We hear that a lot, right? You're a small company, you don't have a ton of cash flow. You kind of have to cut a few corners. We're bootstrapping a little bit. If you want to bootstrap it, you need a PhD in Google. Okay. You want to look up as much as you can, learn as much as you can. There are two great resources that you can go to. It's free. You can look up any type of financial transaction and they'll explain and give you examples on how to properly account for it in GAAP. The best one is FASB, FASB, the Financial Accounting Standards Board. These are the people that set the GAAP principles and help you be compliant with GAAP. Okay. Another place that you can look is AICPA. That's the American Institute of CPAs. There's a lot of good information on there. If you're posting a certain transaction and you're not sure how to account for it in GAAP, you can look it up on those two places. FASB is the best place to look for.
Very interesting. I wish I could go back in time with what you just gave me, as well as all the other folks. Talking to these folks in M&A on this show has been really enlightening, and it's not the first time I've thought, gee, I wish I could go back to that first business I had and do it a little bit differently. But thank you for that. And Chris, to wrap up here, who are you looking for at Xperteks? What kind of, what locations? You guys are in the Northeast, so to give us all the demographics and information you can share with who should be raising their hand to talk to you guys.
Sure. Look, I'll look at about just any reasonable deal. Okay. The ideal target company for Xperteks and for me that I want to analyze is a company that's reasonably compliant with the process that I have in place. Okay. So I'm looking for a few things here. Number one, recurring monthly revenue, contracted. Month-to-month deals don't get it done. They're not going to get you much, okay? Because you're guaranteed 1 month of revenue and then they can walk. But if you have term commitments, we typically do 1 to 3 years initial term with a 12-month auto renewal, okay? So I want to see contracted monthly recurring revenue with a term, okay? That guarantees that revenue is going to be there after the deal closes. Because on the month-to-month or the break fix, we may close today and next month they say, well, I don't want to deal with Xperteks. I don't know them. I'm not loyal to them. I'm walking. So now I just spent millions of dollars on a deal and I'm the one holding the bag. Okay. So that's number one. Number two is GAAP accounting. I want to see GAAP accounting. I don't want to rip my hair out trying to convert you into GAAP. I don't really want to have to come to your office and start pouring through the general ledger. I want to see that everything is in the right place, in the right month, that the numbers look good, that everything is even, from variance perspectives as far as, your income statement and your balance sheet are concerned. I want it to be easy. Why? Because I want to look at your deal. I want to assess the validity of the deal or how it applies to Xperteks. I want to get that initial analysis done. I want to send a letter of intent to you. Then I want to really begin, the big process. Okay. As far as demographics are concerned, or geographical location, which may be a better way to put it, excuse me. I love it in tri-state area. That's where we are. We're in New York City. Our engineers can typically reach you that way. I don't have to hire in your area. That said, if you're not in the tri-state area, I'm still willing to look at the deal. If it's a good deal, it's reasonable. Okay. I can always hire people in that area who'll be able to get to the client's location. Okay. The last thing, and this is so extremely important, and let's think the boy who cried wolf here. I want the ability and the desire to get a deal done. I don't want somebody kind of shopping around to see what their company's worth, or what it looks like, from a sale perspective, and then to back out after I've at least performed my initial analysis. Right? You become the boy that cried wolf, because now maybe you are ready to sell and you're going to come to me. And I'm going to remember that guy. Oh, yeah, that guy wasted my time the last time. I'm looking at 4 other deals right now, and he's the odd man out. Those are the most important things that I look for. Everything else, that can be compromised, that can be discussed. We can always come up with a solution. But as long as those 4 things are present, that's a good deal to me.
Awesome. How do folks get in touch with you?
Well, you can look us up on the web. All of our contact information is on there. There's a general helpline. If you want to discuss this with me directly, you can email me. My email address is cbologna, C as in cat, Bologna, just like the lunch meat, at Xperteks.com. Always looking to hear from people, especially if they've got a deal, or if they just want to talk a little bit of shop. I like talking about this stuff. I'm pretty sure I've gone way over time with you, Mike. I apologize for that. I'm a little bit loquacious. But I like talking about this stuff, and I like looking at deals, and I like talking to other MSP owners. This is always a symbiotic relationship. Sometimes, you're going to scratch my back. Maybe I can scratch your back for you. We can all work together. There's a lot of business to go around.
Awesome. Well, Chris, I can't thank you enough for taking the time out of your very busy day to share with the MSP community. And for everyone watching, we thank you, and tune in every Monday on the Kaseya YouTube channel for another episode of M&A Unpacked. And make sure to look at the show notes over on the YouTube channel for sure, because I'll have Chris's contact info in there, and we'll put in the links to the resources that Chris mentioned. And if you're not yet a member of the M&A Concierge platform for MSPs, make sure to apply today. It's an amazing platform and is 100% free for both buyers and sellers. See you next time, everyone.